There's only one indicator in history that has reached this level once. And every time it got close, what followed changed the entire economy. Warren Buffett developed an indicator that bears his name. It compares the total value of a country's stock market to that country's entire economy. Buffett himself said that when this ratio approaches 200%, you're playing with fire. Today, that ratio has reached 238%. Let's put this into history. In 2000, just before the dot-com bubble burst, this indicator reached 146%, an all-time high at the time. After the bubble burst, the NASDAQ index plummeted 78% in the next 2.5 years. In 2008, just before the global financial crisis, the indicator was at 109%, much lower than today. And the S&P 500 fell 57%. Even when the indicator approached 200% at the end of 2021, the S&P 500 fell 25% within weeks. Today's 238% is higher than all 3 periods combined. Don't mistake this for a mere coincidence, because another indicator points in the same direction. Shiller's inflation-adjusted price-to-earnings ratio is currently at 41, the highest level seen since the peak of the dot-com bubble, which reached 44 at that time. So today's market has only been more expensive than it is now, once in history. Furthermore, the market has never been so dependent on so few companies. The top 10 companies in the S&P 500 now account for roughly 35% of the entire index, close to the record high of 41% set in 2025. So the health of the index is increasingly resting on the shoulders of a smaller number of giants. Wall Street analysts predict that the largest American companies will achieve 25% profit growth next year, an expectation even higher than the optimism at the peak of dot-com trading. And chip giants like Nvidia and Broadcom are trading at more than 20 times the value of their total products sold, not their profits. Of course, this indicator has a weakness. It doesn't tell you when it will explode. At times, the market can remain at an overpriced level for years. But history shows that every previous period when this indicator rose this high ultimately resulted in a sharp correction. Only the timing was uncertain. So the picture we have is this. Market valuation is at a historical high. Profit expectations are at a historical high. The pricing of tech giants is at a historical high. And the health of the index has never depended on so few companies. All 4 are pointing in the same direction. History has only seen something like this once before. Stay asset.